What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 29th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to talk about a whole range of different topics we need to keep our eye on when it comes to crypto markets, and more specifically, that will help us to determine whether or not we're going to be able to sustain a long-term Bitcoin bull market. We've got a lot of things to dive into, as well as stepping into the macro perspective. It's going to be a jam-packed episode, so you guys won't want to miss it. If you enjoy the episode, drop a like. It's one of the best ways you can support the channel, and let's go ahead and kick off the rambling. All right, so I want to go ahead and again emphasize what we're expecting here for the upcoming days for Bitcoin's price. As much as we are convinced that this is a relief rally, that we're going to eventually start to roll over, I don't want to be all doom and gloom. I don't want to be too fearful. Over the next couple days, we could continue to bump up here. We might get a bit of a bolster here in Bitcoin's price, and I'll talk a little bit about why that is later on within the video, considering the macro conditions. But generally speaking, we do believe still that as we come up into this very important channel here, which is where price consolidated during the first correction back in 2021, also as well in a slight support range here before we moved up to the all-time highs in 2021, and also here where we broke down before the collapse going into the summer down towards $17,000. This is a very significant range here, and I would be quite surprised at this point with the kind of momentum that Bitcoin has had, the narrative that a lot of people are chasing right now of there being hyperinflation, a collapse in the banking system, and some form of hyper-Bitcoinization, where essentially the whole world is just going to adopt Bitcoin. With all that narrative chasing around, I would be quite surprised if, as we've come up all the way here, we wouldn't chop around in this range for some time. And this is where, again, a lot of traders, I feel, are going to get trapped. Again, some people feel that I'm being ultra bearish, I'm being ultra negative. Nick, why aren't you trading here with the trend? The fact of the matter is, guys, is that we are still likely in a long-term downtrend here. Just because we're above the 200-week moving average does not mean we have held and sustained signs for a broader uptrend. It's a very important thing we got to realize here, folks. It's not trying to be biased. It's not me just trying to be overly bearish. It's being cautious and not chasing every single potential trade opportunity. Sure, there are going to be some relief rallies. There have been many already. We took advantage of, for example, when we sold our positions back here from the lows in June at a much better range here in price versus that back then. And again, while you can trade these different types of relief rallies, or you can short the rallies as well, the fact of the matter is that we like to wait and get in at the bottom when there is clear signs of capitulation, when everyone is rushing to the exchanges to sell their crypto. That's when we want to start building positions. Essentially put, we're going to be waiting for some kind of chop within this range, which will eventually start to likely break down sometime in late April, potentially early May. These things can take time to play out. Now, there are a couple reasons why we are still confident that we're in a long-term bear market. The Grayscale GBTC Bitcoin ETN product, which allows people to buy Bitcoin from their brokerage account, has seen its discount recover from about 48.8% up towards around 37.3%. But as much as this recovery has definitely been nice to see, I don't want to negate the progress that it's made. At the same time, we seem to be facing consistent resistance around this range at about 35% on the discount range. So this is still showing here that even with a lot of the euphoria and optimism, we haven't been able to correct the premium in the market, which means there are too many GBTC shares initiated. There were a lot created back in 2021, and perhaps too many in order to alleviate the original premium that existed on the ETN product. Because of that, having all these shares ideally backed one by one to respected Bitcoin, we should not be seeing this trading at a minus 37% discount if we've got the fuel to maintain a long-term rally. It's not me being ultra negative, it's just focusing on the facts here. It's showcasing that right now institutions are not buying up Bitcoin. And even the retail crowd, which probably has made a dent here and removing some of this discount, are still not enough to sustain long-term demand for the available Bitcoin supply on the open market. The fact that we have been trading consecutively in a negative pattern here for the GBT product is proof of that. There is not demand to meet to the supply. And if that's the case, if people aren't really taking advantage, and I understand there's like an annualized 2% fee on the GBTC product. I get that. It's not as nice as per se holding the actual Bitcoin itself. But even considering that, the fact that we have a resting 37% discount at the moment on GBTC shares is absolute proof that there's still too much supply in the market versus actual market demand. And someone is going to have to make up for that. Until this kind of discount window is removed, I really don't think we can see a sustained bull market for the long term. Another thing as well that we've got to talk about is a lot of the scare going on when it comes to Binance. Now, if you haven't heard yet, the CFTC, which is one of the major financial regulators within the United States, has come out with a set of allegations and claims that the team at Binance has been running an insider trading desk, trading essentially against its own users in order to turn a profit, similar to exchanges like BitMEX, which used to be the leading exchange within the derivative space of cryptocurrencies. So there have been these kind of broad claims also as well, trying to get US users onboarded. And look, to be completely frank with you guys here, I don't have a direct opinion in either direction. I've met CZ before. I've followed Binance as an exchange for a long period of time. And whereas a lot of players have been flushed out of the space, Binance still stands here today. It's been one of the more resilient players in the crypto space. That being realized, I'm not going to sit here and have a direct opinion in either way. It took 6 months after Celsius had collapsed for us to realize that FTX, Voyager, and so many other players were underwater. And while there are some degrees of certainty that we have here when taking a look at the on-chain metrics, the one thing that stands out to me is not so much the exchange reserves, right? If you look back since November, yeah, they've declined, right? That's pretty much the case for most exchanges. There's been a pretty big movement for people to move their liquidity off of exchanges. That's not really my concern. What is pretty damning, and isn't something critical of, say, Binance, but the broader crypto space, is that stablecoin liquidity has been on the decline. If we take a look at BUSD, USDT, and USDC, the most predominant stablecoins, we've essentially gone from, roughly speaking, again, just kind of summarizing the number here, and we're just looking at Binance's data, but roughly around $35 to $36 billion of stablecoin liquidity back in November, now down all the way here towards around $27 billion. So we have seen a huge net outflow of stablecoins from exchanges, which is drying up available dollar liquidity to drive rallies, to drive a continued bull market. This is not what you want to see at the start of a new bull market, as a lot of people are claiming. Again, as we're talking about here, what drives crypto markets? What drives crypto markets is liquidity, right? If you don't have extra dollars on the sideline through USDT, USDC, BUSD, TUSD, whatever stablecoin you're craving, if you don't have those additional dollars there to drive up valuations are not going to be moving higher. Case in point, guys, at least they're not going to sustain a long-term rally. Sure, there could be relief rallies along the way, but for a long-term bull market, you need that additional dollar liquidity. And to not see, an increase in stablecoin liquidity here doesn't make me so much concerned about Binance as an exchange, but more specifically about the broader trend in the crypto space. So that's what I'm more concerned about here, in the sense of asking whether or not we're ready for another bull market. And again, this has been already a part of a broader trend since back in April of 2022, which is that stablecoin liquidity in the two largest plays has been on the decline here. Essentially, we've gone from around $132 billion or $133 billion in liquidity down towards around 112 right now, with an absolute low around $107 billion back in November and in December. So the key point is this: if we're not seeing a broader rapid expansion in stablecoin liquidity, and there's also concerns around closing on-ramps in stablecoins, as I think a lot of people are not only concerned about the regulatory discussions, but I think the long-term picture, which is, again, a Fed stablecoin or some type of Fed digital dollar. this definitely could potentially freeze one of the biggest on-ramps into cryptocurrencies. So I'm not saying that I'm so much convinced of the kind of doomsday, oh my God, stablecoins are going away. But at the same time, I'm not really optimistic with what I'm seeing with stablecoins at the moment. I'm just trying to be realistic with you guys. If we take a look back throughout the past couple of years, even during the initial stages of the last bull market, and really this was still bear market territory, we saw rapid expansion here in stablecoin liquidity following Bitcoin's price action. A 37% month-over-month increase, a 12% month-over-month increase, another 13% increase, and another 13.4% increase month after month after month. And this time around, since November, since Bitcoin's price has doubled here, well, we see stablecoin liquidity going from around $108 billion or $107 billion at the low to where it is now at $112 billion. A $5 billion increase in stablecoin liquidity isn't going to get me excited. Month over month, we've increased practically single digit month over month, if you consider that we've had negative months in between. That's not the kind of thing that drives bull markets, folks. And that's, again, why I really want you guys to heed caution here. We are always observing these different types of metrics. I'm scanning through dozens, if not 100 plus major charts like this throughout any given week. And as we observe the macro picture, as we see multi-billion dollar banks like Silicon Valley Bank or First Republic Bank getting wiped off the face of the earth here, this is killing a lot of equity value. It's getting investors definitely concerned about where they have their capital exposed to. And I think we need to ask the question of whether or not they want to be exposed to cryptocurrencies. Now, I understand the narrative here, which is that, oh, well, Nick, these banks are going under. Don't people want to get their money out of the financial system? And sure, there's definitely been a bit of bank runs. There's been people worried about the broader financial system. But SVB, Silicon Valley Bank, all the depositors are perfectly fine. They got covered by the FDIC. First Republic Bank as well, same exact case scenario. It's not the depositors that are to worry, at least at this point. I know Balaji and many other people who are making these bold claims about where Bitcoin's price is going to go are saying this and telling you this thing, and that in 90 days, the system could collapse. That's not who needs to be concerned right now. Who needs to be concerned is those exposed to the underlying assets, the equity in these types of vulnerable assets. And now the only person who's really lost here are the shareholders of First Republic Bank, those who've been the shareholders in companies like SVB. All right, same exact thing here with any single bank that's been going through these tightening conditions. And this is, again, as we've dropped down here since our highs back in January of 2022 at around $69 here for the IAT or iShares US Regional Banks ETF. We've gone from around $69 and practically sliced it in half down here to $35 per share back during pandemic territory in 2020. Now, what's interesting is I know a lot of people are betting on this falling off the face of the earth and continuing to go down. And to be honest, I wouldn't be shocked if we continue to see some contagion in the regional banks. But I got to be honest with you guys, with the Fed coming in so swiftly, not bailing out the shareholders, and more specifically, coming in and protecting depositors, this is definitely an interesting sign that, especially with the Fed raising the federal funds rate by 20 basis points here in the last meeting, or 25 basis points, yet again continuing to heighten rates. I understand a lot of people are focused on the balance sheet, but the fact that the Fed is still keeping rates suspended here tells us that they're likely going to continue tightening, that this may have been a smaller kind of collapse within the banking industry and isn't going to be some contagious event as those deposits are finding a new home. They're going to the larger established banks. So this likely doesn't mean that it's anything close to 2008 or to the 2000 bubble when it comes to financial markets. But in reality, this is just a traditional contractionary and recessionary environment. Now, I want to go ahead and pull up a really interesting set of charts here. First off, we're not only seeing bond yields still holding up here since back in mid-March. So they're staying above that 200-day moving average, which is a sign that the Fed is going to keep rates suspended higher. The markets probably reacted too swiftly. Maybe some of the shorter-term bond yields are facing a harsher rejection, but even if we take a look at the US 2-year yield, A lot of those losses here, we've gone up about 0.5% on the treasury yields, back to where we were in early March. It's definitely not where we were before. We're still down an entire percentage point, right? But we're still seeing rates generally where people expected them to be since back in September of last year. So no pivot when it comes to the federal funds rate just yet, at least according to bond yields, right? But on top of that as well, the VIX here is already down pre-market towards 19 points. Now, sure, we got the spike here as we called for on the channel. Something was ready to break as we discussed for the past couple of weeks pointing to the VIX. But if the VIX is back down here, volatility is low, and it's not holding above the 200-day or 200-week, likely means that stocks will continue to rally for a couple more days, couple more weeks. That gives room for the Fed to do all the tightening it needs. It tells us that the job is not done yet. The fact that the VIX has not been able to get above the 33-point line, even when it seemed the entire banking system collapsed, where banks by total assets almost outweighed the entire losses of back in 2008. Right, when we're talking about banks closing down by their total assets under management, right? When measured by assets under management, you could see we had what many people felt was our 2008 moment, and the VIX can't even get above there. So this is building into my point here. This is not some massive banking collapse or complete loss of trust in the dollar, but it's also not sunshine and rainbows. It's a recession, not some massive depression. Not everything's green and the Fed's just going to print and lower rates and we're just going to go to la la land. It's a recession. It means earnings are going to contract. Credit is contracting in the economy. Capital is getting more expensive, and that is not going to be a beneficiary environment for equities, let alone cryptocurrencies. The same reason for the last decade crypto was the best performing asset in an era of easy money is why it is going to suffer and face difficult challenges and contract and generally set lower highs and lower lows during a period of monetary tightening. And folks, the big thing here that really lets me know we're about to hit that recession is what we're seeing here within the bond markets, the yield curve. We talked about it in the last episode. If you guys want me to definitely go more into it and stuff, I can talk about it more in future episodes. The significance, the historic relevance that this has at predicting recessions. But the major bump we had here is not a sign of optimism. It's a sign that things are about to get worse. The last time we saw this, the last few times we saw this, was in January of 2001, the start of the dot-com bubble, right, as we went into the late stages of the 2000s. Here in 2007, leading up into the 2008 recession, it doesn't happen overnight. And that's the problem that so many people struggle with, is they expect it to just be something that happens right away. But it happens slowly and steadily. It catches people off guard, because people get caught up in the optimistic narratives when it seems to be paying off. But they don't prepare themselves for when things start to revert. We've been following the federal funds rate. While a lot of people thought the Fed funds rate was going to go 3 or 4%, we had predicted as far back as August of this past summer in 2022 that this was going to go all the way up here into the 5% range. And it looks like we're still well on pace for that here, for the Fed to continue raising rates. Why is this here? Because at the end of the day, the worry we have that the Fed needs to tame is inflation. Last month, the PCE for January came in at 0.6%. This was the biggest month-over-month expansion in the PCE. Mind you, it's a more kind of conservative measure of inflation versus that of the CPI. And we had a 0.6 month-over-month expansion after already still having a 0.2% expansion in November and December, a 0.4% expansion in October. This, to me, I don't know about you guys, but this looks like the Fed has lost control. And that by only going up 25 basis points, starting to slowly curb the rate hikes from 75 basis points to 25, tells me everything, that the Fed hasn't done enough. and that they're going to have to work even harder. They're going to have to raise rates even further, as we've talked about over the past couple weeks, in order to contract this. We'll see. We'll have to see over the inflation data over the next month or so. I don't want to speak in absolute terms, guys. I gotta put my cards on the table and give you guys opinion. If I just sit here and say, oh, go up or down, whatever, it doesn't make sense for me to do YouTube here. There's a dozen other people out there who will tell you, oh, maybe it go over, maybe it goes down, and oh, the market just dumped down. Now I've changed my mind. I'm going to be honest with you guys here. This is a generally contractionary environment. Interest rates are incredibly expensive comparative to what they were over the last decade, practically at near zero. The kind of risk-taking that happened over the last decade cannot happen this time around. It's also why I'm a bit kind of conservative about technology stocks. I know a lot of people are really excited now. We're getting above the 200-day and 200-week moving average finally, and it's looking like we might be able to start breaking away. There's the narrative around AI that people are getting excited about. But I think one of the prime examples here is to focus on what's leading the market right now. And that is, again, companies who are exposed towards creating different types of semiconductors, creating different types of GPUs, CPUs, different types of computer components that could benefit from an overall move into this trend around AI. Now, while I'm definitely excited about ChatGPT, OpenAI, all the major breakthroughs that are going on in AI right now, it's definitely a very powerful industry that's going to play a role over the next decade during that next bull run. That being said, I think people are chasing the trend too early. Semiconductor companies right now, like Micron, over quarter has dropped from making an average of around $2.5 billion per quarter to now facing losses in Q1 of 2023. There is a major glut in supply of semiconductors and computer processors in the market right now. And it's not just players like Micron that are suffering from this. We have yet to see the Q1 financials for companies like Nvidia. Revenues are still sharply down from where they were in 2021 and 2022. And while margins have bolstered over the past few quarters, which is definitely a good sign to see here, Nvidia is one of the best potential players in the market to benefit from this AI trend because of the fact that it's a GPU manufacturer, and Nvidia leads in this market. If Nvidia comes out with disappointing earnings, and at the moment is trading at a whopping 152 price to earnings ratio, which is absolutely absurd, even if you're bullish on AI. If they come out with disappointing earnings, if they miss the beat on what they're expecting, this is going to be disastrous for equity markets. This is one of the few strong pillars that is holding up the tech sector right now. When you compare the broader tech sector as a measurement, if you remove semiconductors from that equation, it's pretty disastrous when you're really measuring in the FANG stocks. Nvidia is one of the last hopes here, along with Microsoft, due to its exposure to OpenAI. These are the last few hopes here, but it has already deviated quite directly away from that 200-day. Already gone from around $100 a share, almost up towards $300, around $264 a share. Is that really a bet you want to go long on in this market? Everyone will have to determine their own path. But for me, guys, it's just how I stand at the moment. I have much more to lose than I have to potentially gain by chasing these rallies. Case in point. And look, at the end of the day, guys, coming back to Bitcoin, because I understand that a lot of you are watching these videos and you're like, man, Nick, I'm worried I'm going to miss out on the next bull market. And I feel sometimes we're too negative here in the videos. But folks, I understand it's never fun to have to go through bear markets. But you want to know what is so much more worse than missing out on a rally or having to go through bear markets is losing more money than you possibly already have. Or let's say you made some great gains and then you go out there in the market, you get in some leverage trade thinking that what Balaji and all these people are telling you is so true. The banking system is just now going to collapse. Folks, maybe one day it is going to collapse. Maybe there is going to be some major correction and distrust of the dollar. Maybe we see that in our lifetimes. But if you make one wrong trade on leverage, if you try to long the market or even short the market without proper risk management, which so many people out there who are telling you to go make trades are not giving you, you could end up losing everything. I've met too many good people, too many kind-hearted people who have worked so hard for their money, and they just don't know how to protect it during the bear market when there are tons of sharks, from exchanges to inside traders to market experts, who are going to take advantage of it. They will take out your stops. They will knock you out of your positions if you take too much risk. So I just want to be practical, guys. I want to help you protect your capital, because if you can preserve that capital and strike when we get real capitulation, when no one's going to be willing to buy, when no one's talking about crypto, when all hope is lost, that is the moment you strike. There is still too much euphoria, and we've got to be prepared to sit on the sidelines and wait for that opportunity to strike. The best traders I know strike in the least amount of trades in a given year. Trade sometimes 2 or 3 times a year, waiting for those opportune moments when things are getting too extreme in either direction. And I think right now, the bullish narrative is getting to pretty absurd lengths, and it may continue as we go into 28 to 32K here over the next couple of days, where we could start to finally get into territory that may look optimal for a short. And if we do engage in anything like that, which we're not short right now, right? We are in cash, right? If we ever look at doing a position like that, I will let you guys know. But until the next video, everyone, thank you all so much for watching. If you guys could drop a like, it's one of the best ways you could support the channel. But until the next video, everyone, I'll see you all in the next one. Take care, everyone.